Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Shehzad Qazi, Managing Director of the China Beige Book. Shehzad specializes in emerging and frontier markets, as well as crisis and transitional countries. He's conducted macroeconomic market intelligence, strategic communications research on behalf of corporate, government, and nonprofit clients in the U.S., Asia, South Asia, Middle East, and Africa. Welcome, Shehzad.
Hi, thank you for having me on.
Great. I thought we'd look at the China Beige Book. What is it? How do you capture data, and where you get your data from? If you can give us some background on that, that would be great.
Certainly. So China Beige Book started well over a decade ago. And the original idea behind creating this company was that when we looked around, we saw that there was no shortage of China economists and very smart people talking about what was happening inside China. The one hindrance for them, and for us as well, was that everyone was reliant on what the Chinese government was putting out in terms of its economic data. And everyone knew that that data suffered from a variety of problems. Not only was it the most commonly heard thing, which is that the data were being manipulated, but the data were often lagging, they were severely revised, or perhaps in some ways most important, they weren't enough to capture every aspect of China's economy. So our thinking was that rather than creating a company that just focuses on talking about the Chinese economy on the basis of official data and creating various China outlooks, by perhaps taking parts of that official data and reconstituting it, we should first and foremost be a China data company and then become a China macroeconomic advisory and analytics shop. And so that was the idea behind creating CBB, as I said, well over a decade ago. Over the last 10 years, the model is that we survey thousands and thousands of Chinese companies on the ground. We cover, we conduct surveys every month of the year, put out data every month of the year. But when aggregated over the course of any given quarter, we survey over 4,000 Chinese corporates. This covers the full expanse of the Chinese economy, every major sector, every major firm type, as in state-owned companies, privately owned companies, large firms, SMEs, even micro enterprises. And of course, geographically, we like to cover every part of the country, all the way from Shanghai out to the western borders of the country. The goal has been always to be as comprehensive as possible, so that we can walk away with the results with as much confidence as possible. So that's the quick and dirty overview, as I call it, of what China Beige Book does and how it came into inception.
Interesting. And what type of metrics do you look at? Like, for example, do you look at import-export data from the perspective of China's trading partners?
So not only has the goal been to be comprehensive in terms of your methodological, your survey method coverage and your sample coverage, but also be as exhaustive as possible in a survey in terms of the various parts of a business that matter ultimately, and that when aggregated over the course of any industry or over the course of the entire economy can give you a sense of how things are proceeding on the ground, whether it's growth, investment, inflation, labor market dynamics, or of course, the most important part, I think, when it comes to China, credit and shadow finance. So we ask companies about whether, how their sales conditions are, whether their sales revenues are increasing, staying the same, getting worse, sales volumes, prices that they pay for their inputs, prices that they charge, wages wages for their workers. We ask companies if they're borrowing, who they're borrowing from, what rates they're paying, if they're not borrowing, if it's because their loans are being rejected, or if there's another reason. On and on, I could go with this list, but cumulatively, we're looking at over 65 different indicators of business performance on which we track these 4,000 plus Chinese companies.
And if you could briefly describe what are some of those 65 indicators?
Sure. So as I said, there are things like sales revenue, profit margins, sales volumes, production or output, domestic orders, export orders, capital expenditures, size of the workforce to gauge hiring and layoffs, borrowing, bond issuance, the types of non-bank lenders perhaps that they are getting credit access from, the rates that they're paying for the loans that they're getting, and so on and so forth.
Is there any process in place to ensure that data is consistent from different sources and the quality of the data quality?
Yeah, those are the number one, concern areas, whether it's us over here at CBB or if it's people who are the clients, the various fund managers and CIOs and so forth who purchase the data and look at the data. There are a series of things that we've tried to do to make sure that the data are of the absolute highest quality. One of the first things that's very important here is who exactly are you speaking to, right? So are you serving those members of a company that are senior enough to where they are familiar with the company's performance, that they can accurately describe to you in trend terms where things are headed and where things have been. So we make sure that we don't serve a manager level or account manager or purchasing manager or any of those various junior titles, but instead actually interview senior decision makers. That is one of the most critical things that distinguishes CBB from various other business surveys that are out there that are typically reliant on sales managers or purchasing managers or account managers and so forth. So interviewing senior decision makers and as senior as possible all the way up, we're talking general managers, executive vice presidents, CFOs, COOs, all the way up to the president, CEO level, especially when it comes to some of the SMEs as possible. That's criteria number one in ensuring data quality. Along with that, of course, goes with the idea that, folks have to be involved in decision making. But beyond that, there's several things that are important to do in a survey, which again, which distinguishes China Beige Book. We're not in the business of putting out what are otherwise considered by us to be longitudinal studies. And what I mean by that is almost every other business survey, they survey a few hundred people. First of all, we survey a few thousand, as I said, but they'll survey the same people over and over again. And the problem with that is that you walk away knowing just what those few hundred companies are doing, which is not entirely representative of the economy as a whole. We, on the other hand, don't only have a very large survey sample, which plays into data quality. Numbers are very, very important, as you know. But we make sure that we cycle out so that we're not getting biased in any one direction or the other. So cycle out respondents and make sure that you're getting as representative a snapshot of the economy in your sample as possible any given month or any given quarter. So those are just a couple of the sort of top level things that are done from a sampling quality and data quality standpoint. There's a host of other mechanisms that goes into in terms of survey data, how the survey is structured in terms of its questions, the strictness with which we monitor our sample demographics to ensure continuity and compare, that they're comparable from any one quarter to the next. A lot of strict mechanisms by which the survey data is weighted. I could get into the technical things, but that may lose some interest among the listeners. But the point is that a variety of things have to be done in order to ensure that the data you're collecting is actually useful. It's giving you signals, and that's been the track record. 10 years down the road, we've been able to call every major macro trend within the economy.
Mm-hmm. Very interesting, very powerful. And you've been very gracious in sharing a piece that you recently put together a couple months ago, Facts and Expectations, the Misunderstood Path of China's Economy into 2022. Can you discuss those conclusions and those differentiators between facts and expectations, and how you put together the data to come up to those understandings of trends and conclusions?
Yeah, in my opinion, this has been probably one of the most critical pieces of analysis that we have released in the last several years. Over the last couple of years, since China, shut down because of COVID and then began reopening, Wall Street's and various sell-side research, their expectations have been missed consistently. And there have been several major issues in how we've seen, the China story being told, and especially the forecasts and the predictions that have come out on, and the expectations of the market alongside that. It begins with where things were in 2020. So after the Chinese economy reopened, it's pretty much consensus that it was China's industrial economy, the manufacturing segment, commodities to an extent, property. It was this part of the economy that was leading the rebound or the recovery from the COVID-induced recession. The notion that developed somewhere around late 2020 was that, yes, this has been an industrial recovery, but soon enough into 2021, we're going to also see the consumer side of the economy become really strong. And then we're going to get this, twofold, powerful growth story coming out of China, where industry will continue booming and consumption will really take off. Now, there wasn't any evidence within the data. We survey hundreds and hundreds of retailers in any given quarter, as I mentioned. And as the results from the retailers were coming through to us, it became very, very clear as we got into 2021, and it became even increasingly clear as we got into the middle of 2021, that there wasn't going to be, and there hadn't been, any type of consumer-driven rebound in China that markets were expecting or that Wall Street had been forecasting. And this became abundantly clear into late summer and into early fall. This was also being very, very clearly shown in Chinese official data. Retail sales slowed for something like 6 months in a row or so forth. And it was very clear that the markets had gotten the China consumer rebound story pretty starkly wrong. That, of course, has serious implications for investors. That was number one. So that's the first, facts versus expectations part of the story. Now there's a number two section to it, which is, what did markets then think was going to happen? When there wasn't a consumption recovery, a new theory developed, especially around the summertime, which was that, yes, the Chinese economy is actually, unfortunately, a lot weaker than expected. And now we're going to have to see, and now we're going to get a stimulus boom in China. So there's going to be a lot of policy easing, monetary policy easing as a result of this economic weakness. Now that ended up being proven incorrect as well. And, into the fall, it became very, very clear that there wasn't going to be any type of stimulus in China. This was something that we had been forecasting all throughout 2021, not because we were making up numbers or had some fanciful theories about how the Chinese economy works, but because we were looking at our data. When you survey thousands of companies on the ground and you see borrowing decline quarter after quarter, it becomes very clear that there isn't any type of credit stimulus taking place in the real economy, that the credit taps are not being opened. And so we came out and said that, look, this idea of a big bang stimulus happening in China is also incorrect. You're not going to get that. And of course, as credit data over the last 9 months, again, official data have tracked CBB. And over the last 9 months, they've shown very clearly that there has been no stimulus, no monetary stimulus, no policy easing that has taken place in the Chinese economy, despite the slowdown in retail sales and despite the overall lackluster consumer economy that we've seen over the last year. So these are the two big facets of that myths versus facts, or expectations versus reality story that we've told or we told back in September. And now undergirding this is, of course, a larger trend that's taking place. But I'll pause for a second because I think there's something very interesting that happened all along, as a matter of fact, which helps us understand why there wasn't stimulus. And perhaps that fact or that factor is what was really missed by the markets.
No, go ahead. Yeah. What is that factor?
And that factor is that a paradigm shift has taken place in China. And the paradigm shift is how the Chinese Communist Party is increasingly thinking about its economic policy and its economic management. That old playbook that China watchers have been so familiar with, which is that at any sign of weakness, any type of slowdown, you get a credit event take place, and more specifically, you get policy easing take place. You see banks being ordered to lend out to the firms or the sector that's in trouble, and you see a recovery take place. Or of course, the larger part of that, the old economic model that you had, which was investment driven growth, build, you know, take out as many loans as possible, raise as much credit as possible, and debt levels seemingly did not matter as long as growth was being had. That old playbook, that old China growth model, has run out of road, and I think the party has understood this, and the party is now increasingly focused on bringing down the debt levels, moving away from that investment-driven model of growth. It's hoping to transition the economy towards a healthier pace of growth. But the end result of that, and as a matter of fact, the result of that now, as the party embarks upon this transition, is that overall growth levels are going to slow down. They've already slowed down. They are going to slow down, and the party is comfortable with that. And I think that is, that paradigm shift, that going away of the old playbook is something that markets, folks on the street, sell-side research analysts, they all, I think, ended up missing, which is why they kept predicting that big bang stimulus that never took place, because folks weren't ready as yet, perhaps, to admit, or weren't clearly looking at at enough data to understand that something very meaningful had changed, and that perhaps there is a new playbook that's being written as we speak.
And so, do you see any trend changes from when this document was written back in September to this month? Today we're here at December 7th. Any changes in trends?
So, the economy is, we're still collecting our fourth quarter data. And I would assume that, we may see some mild improvement in the numbers in terms of overall aggregate performance of the economy into the fourth quarter. But the overall trend, of course, points towards slower growth when you look at manufacturing. You're seeing certain amounts of slowdown in the services sector, and so forth. You get some seasonal improvements in retailing, but given the Singles Day and end of year purchases and so forth. But the broader story remains that the economy is, of course, is slowing down, that it's not nowhere near those pre-COVID levels that we had gotten used to. Of course, the most interesting thing is, well, fine, but what's happening on the government side if the economy continues to slow down as we enter this all-important political year in 2022, kicks off with the Beijing Olympics. In the fall, you get that all-important party Congress where President Xi is expected widely to get his third term. Now, if you're seeing the news over the last couple of days, there have been some additional RRR cuts in China. And once again, just the way they did in July, a lot of investors are thinking, this is it. This is the moment where Beijing stepping in with its stimulus to the economy. Small firms and private and medium-sized firms are struggling. So this is really being done to stabilize them. And you're going to see some rate cuts early in the year that are going to follow from that. I agree with part of it and I disagree with part of it. I agree with the side that, yes, you're going to get some amounts of stabilization of policy and some amounts of policy support as you get into 2022. We actually said that in that fall document, that there is a political calendar on the basis of which you are going to get stimulus. But it's not because there's a panic inside the CCP on the economic numbers, but because you're getting into a politically important year where stabilization of the economy and broader social conditions, of course, is going to be very, very necessary. But this mini liquidity event that you've seen taking place in terms of the RRR cut that a lot of market watchers are getting very excited about. And some folks may come and say, look, we said there was going to be broad policy easing and this is it, and may try to claim victory. I think that would be a little bit disingenuous. You're seeing sort of very minor things take place. You're not seeing that all out opening of the credit spigots as yet in China. Now, again, as we get into 2022, I wouldn't be surprised if you see a little bit more of that take place. But that is sort of an important event that's taken place in the last couple of days, which a lot of your listeners may be interested in understanding better.
Does your data indicate a major shift from trade and investment-based economic development to domestic-based consumption economic development?
Yeah, this is another very, very critical thing. Over the last many years that we've been doing this, one of the things that has really stood out is that you've heard terms being thrown around such as rebalancing, and a lot of folks in the past have talked about the shift from investment-driven growth to consumption-driven growth, especially in 2016, 2017. This was a very popular theme on the street again. But that just hasn't panned out in the data. You'll get these quarters or these months where retailing will do really strongly or services will perform really well. But you don't see it last consistently quarter after quarter and year after year, number one. And number two, in times of stress, when the economy has slowed down, for example, when the trade war took place, or as I said, most recently, when you had this COVID-induced slowdown in the economy, you just haven't seen consumption pick up the slack and been able to, really buoy growth and drive growth, more importantly, in terms of, sales and expansion in that format, but also investment, being able to take on, drive the labor market recovery and so forth. So that's a long-winded way of saying consumption has, as yet, never been able to take the role that investment and manufacturing and the industrial side of the economy has had in driving the economic expansion thus far. Now, this is what we are going to be watching for, because as I mentioned earlier, this is the critical thing. The goal of the party is most certainly to transition towards a healthier form of growth. This is not going to happen overnight. This is going to happen over a course of several years. And that's where tracking the data on the ground, seeing how the various sectors are performing month after month, quarter after quarter, and subsequently year after year is going to become absolutely integral. And watching the policy side in terms of what kind of support is given to the private firms, to SMEs, that's going to be integral because, as you know, the consumption economy is predominantly SMEs and private firms. Your industrial economy is predominantly large firms and SOEs. So what happens ultimately on the policy side for SMEs and for private firms is also going to be very, very key. So far in the data, there's nothing that suggests that there is any type of massive revolutionary change in the numbers that says that that the transition towards consumption has kicked off strongly and is looking very, very strong. It's too early to tell, to be fair.
Interesting. And if we look at the 65 indicators you mentioned, have you done any correlation studies that may indicate that one or more or a collection of those indicators is able to serve as a leading indicator of some metrics in the financial markets or prices of industrial metals, for example? Have you done those types of studies? Is it possible to use your data in that regard?
Yeah, it's most certainly possible. We do quite a bit of that internally. To the extent it's our clients can utilize it. We most certainly showcase a lot of that to them. And we have, as a matter of fact, publicly written about China Beige Book serving as a leading indicator as far as changes in the business cycle are concerned, but also specifically as several metals prices, et cetera, are concerned. Your question reminds me of for example, the things that we've seen historically or in the past in the steel sector. This is both true of what happened back in around 2017, but also true of what happened this year. Briefly touching upon the 2017 stuff, from time to time, you get these stories in China where the government starts clamping down on the polluting industry such as steel or aluminum, and says that, look, we're going to have capacity cuts take place because of environmental reasons. And each time that happens, markets tend to panic and they say, oh God, the supply is going to go down and the prices of with steel or whatever else you may have are going to absolutely skyrocket. And so you get a lot of activity taking place in those markets that are based purely off of what the government has announced. Something similar to this happened throughout 2017, where the idea was that steel capacity was being massively cut down in China, and therefore supply was going to go down and steel prices were going to go up. Um, if you looked at China Beige Book data, our steel firms that we were serving, hundreds and hundreds of them again, were actually telling us that capacity was not going down, it was going in the opposite direction. Capacity continued to go up rather than go down, because what was going on simply is that old and outmoded equipment production and other things and technologies were just simply being replaced by newer, better technologies. But because the market had assumed that supply was going to go down and prices were starting to skyrocket, these producers, rather than cutting back on production, had every incentive in the world to make profit and just produce more and sell more. And so you got the opposite result happening, where a year later, again, official data went on to show this. Rather than less supply in the market, you had more supply of steel in the market, and rather than and ultimately you saw in through the second half of 2018, steel prices just absolutely plummet. But had you been tracking China Beige Book data in real time, of course, you would have probably been a bit flummoxed and surprised that steel production and steel capacity is going up when it's supposed to be going down. But ultimately, that ended up being very well the case. The reverse, the opposite of that story, perhaps, can be told at least so far for this particular year, where there was this idea that there was going to be a China-driven commodities rebound globally. And there was, again, just nothing in the data that suggested that there was going to be this big commodities-driven global rebound, but specifically because of what was happening with Chinese, steel production or aluminum production and so on and so forth. And look, end of the year, we're talking about a property crisis in China. We're talking about construction slowing in China. We're talking about, the economy slowing down. And none of those theories or theses about China driving sort of this global commodities boom have panned out at all this year. And again, if you were tracking CBB data, that would have been very, very, very clear. So there are lots of instances in which, the data have rather quickly, I would say, or surprisingly quickly, been proven to be true. And so we take those instances, and of course, then we look at the longer term trends as well, and see that, try to understand what else can be predicted out on the basis of the numbers.
Mm-hmm. And final question on ESG type of activity. Do you have data, or are you collecting data in that regard in two ways? Like, one is perhaps looking at businesses, companies in China, and how they're doing in terms of carbon emissions, scope 1, scope 2, scope 3. Are you looking at that? And also, secondly, in terms of the investment into technologies, like on the environment, do you see any trends in that regard, like investment by businesses in China towards, greater environmental type systems and technologies?
Those tend to be things that particular clients have a lot of interest in. And so there are certainly more customized projects that have gone into play in the past that I anticipate coming down the pipeline. That is not something that China Beige Book tracks as part of its regular, off-the-shelf economic tracker that we have out there. But there are most certainly a variety of clients who are incredibly interested in, keeping an eye on that and utilizing that. And as a matter of fact, it's a lot of your industrial metals and your commodities clients who also tend to be very, very interested in understanding how the environmental side is how the environmental policies are impacting what different firms are doing, because ultimately it feeds into the bottom line. It feeds into, of course, other upstream and downstream prices of other input metals and stuff as well.
Mm-hmm. Well, that's great insight, and really admire your approach and how you're doing the processing of the data. How can our listeners learn more about your work?
Yeah, so I always suggest two things. The first one is we have an incredibly lively Twitter account, and it's very simple. The handle is @ChinaBeigeBook. So I would say get on Twitter, follow us. We put out quite a lot of commentary, and from time to time, as a matter of fact, we do these sneak peeks where we'll put some of the CBB data, some charts, some graphics out there with a little bit of we're sharing our views in terms of where things are. They happen well after clients have seen them, but we like to release things to the extent we can, sometimes on over Twitter as well. So I would say get on there and definitely follow us for both commentary and data on all things China economics, and China geopolitics. Give our website a visit as well, www.chinabeigebook.com. Again, a lot of recent content is made available through the website. A great way to stay on top of what we've been doing, what we're seeing, and what our view is on some of the most recent market developments and other broader developments on all things China, as I said.
Well, great. Thank you so much, Shehzad.
Absolute pleasure. Thank you for having me on.
Great. And there. And by the way, would it be okay to share the 5-page PDF with our listeners? Is that okay? The one that you sent, or is that?
Let me just quickly confirm that internally, because I can't sign off on it on my own.
Yeah.
And just so I know, are the listeners, is this like a subscription thing where it's only a few people, or is it just freely available via a link on your website, or what would the distribution look like?
Yeah, we have we have a few ways we go out. So we have an email distribution list that goes out to maybe 1,000 subscribers, but we have it on the website, so people could download it from there without being subscribed to the email distribution.
Got it.
Twitter, whatever we post on the website goes out on Twitter, and then there's a YouTube channel.
Awesome. Okay.
Yeah,
that sounds good. And it occurs to me, if for any reason this the full 5-page document, since that was a client-facing work product, if for any reason that is not approved, and even quite frankly, a more accessible version of this, we had rewritten for Barron's. So let me get you the link to that as well,
sure.
Because it's actually the full thing. Quite frankly, I think it's even more accessible and more straightforward in the way that's written, as you can imagine, just because it's for a quick read. So that might also be something interesting for you to distribute out. And I'll obviously check on this as well and get back to you in either case.
Awesome. Yeah. Thank you so much for that. Thank you.
Yeah, my absolute pleasure. This was great. Thanks for having me on. Hopefully you got this met your expectations. I wasn't sure how long-winded or not to be, but I figured it's a longer podcast, so I could give more details. So, love to do it again.
Okay, awesome. Thank you so much, Shehzad. Thank you.
Yep. You got it. Okay, great. Talk to you soon.
Okay, take care. Bye-bye.
Okay, cheers.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.